With so much bad news in the media lately, I understand why many property investors are concerned. One commentator says we're in for the mother of all property booms, and another says we're in for a significant drop in property values. The Reserve Bank says our economy is growing too fast and we need to slow it, and some commentators are suggesting we're going into recession. Regular readers know I've suggested that you should be alert but not alarmed by all that's going on. However, more and more of the researchers that I've been reading that I respect suggest there's a strong upside for property. Recently, I read a report from PMI Mortgage Insurance and BIS Shrapnel which explained why rents are going to explode over the next decade and have a positive impact on property values. They explained that in 2003-2004 we built 174,000 dwellings, but now it's dropped down to closer to 157,000 dwellings, hampered by rising prices, difficult affordability and interest rate rises. Yet at the same time our migration and our population growth reached record highs, causing an increased demand for dwelling accommodation. And again at the same time our national rental markets have tightened considerably, with vacancy rates falling below historic lows. At the same time our national rental markets have tightened considerably, with vacancy rates falling to historic lows and significant rental growth emerging in all our capital cities. We currently have a significant undersupply of properties, and this is likely to get worse as in all states, with the exception of South Australia and Tasmania, we're just building too few dwellings, much fewer than are required by underlying demand. Now it's often said that a balanced rental market has a vacancy rate of 3%. What this means is it allows rents to grow in line with inflation and the rise in the price of other items. But like everything else, rents are affected by supply and demand, and when there's an increased demand and a diminished supply, it's likely that rents are going to rise significantly. A number of researchers are suggesting that capital city rents could rise 50% over the next few years. But the big questions are, can people afford the higher rents? And of course, what will this do to property values? Both the BIS Shrapnel report I just quoted and another one I recently read from Michael Matusik suggest the average renter can afford higher rental payments. They suggest that while many people rent because they're unable to afford their own home, nevertheless, there are groups of people who rent by choice and who've got significant disposable income. Looking back at how rentals have performed over the last decade or so, initially rents have only gone up about the same as inflation. In the meantime, property values have obviously risen considerably more than this, meaning that investors have received lower yields. In the last year or so, rents have started to increase significantly, and throughout most of 2008, rents have gone up 2 or 3 times the average increase for the previous few years. So back to the question I asked before, can renters still afford to pay more? Now, recent figures from the Australian Bureau of Statistics suggest that 42% of tenants have got 1 spare bedroom, 19% or so had 2 spare bedrooms, and about 3.5% had 3 spare bedrooms. Now this doesn't surprise me. Lots of people have got a spare bedroom. They use it as a study, as a TV room, whatever. But what this does show is that renters have the capacity to either take on others to help share the rent, or they could move into smaller accommodation if they really had to. Looking at the 2001 census and comparing average rent as a percentage of average income then, tenants paid a much higher portion of their income on rents in 2001 than they do now. In 2001, rent was in the order of 25 to 27% of the average income. Currently, rents account for 21 to 23% of the typical tenant's salary. This suggests that rental affordability is not as big an issue as some would make out. Currently, rents are more affordable than in 2001, suggesting that, moving forward in the next couple of years, there's scope for rental growth well above income growth. And considering the tightness of our vacancy rates, this is very likely to happen. Given the existing economic circumstances and the level of interest rates, it's really unlikely that new dwelling construction will change much in the short term. This will mean that our vacancy rates will only keep falling and rents are going to have to rise strongly in the next 2 or 3 years. I realise I'm throwing lots of numbers and facts at you, but I'm going to be explaining this in much more detail, plus the true impact this is going to have on our property values at my upcoming Understand What's Really Happening in the Property Markets seminars. Click on the link below to find out when Ed Chan and I will be in your state in August and September. Well, over the last couple of years, mortgage affordability has obviously decreased. In other words, owning your own home was more affordable in 2001 than it is currently. Moving forward, however, it's likely that continued strong rental growth will eventually make renting a less attractive option, and more people are going to consider buying houses. But there's nothing new about this. It's just part of the normal property cycle. At the same time, the dual impact of falling interest rates and rising wages will improve mortgage affordability, and so the cycle moves on. Also, with increasing yields and rising property values, property investors are going to eventually return in droves to the market, further pushing up prices. So as a property investor, you must remember you receive your returns in 4 ways. Number 1, through capital growth. Number 2, through forced appreciation when you undertake renovations or redevelopment, when you manufacture some capital growth. Number 3, through rental returns. And fourthly, through tax benefits. We're now moving into the next stage of the property cycle, and the strategy many property investors used over the last few years, and in fact used successfully, may not serve them well in the next few years. In fact, it may see them going backwards. And that's why Ed Chan and I will be presenting our research and our strategies for predicting your assets and helping make you a more successful property investor in this new climate at our upcoming Understand What's Really Happening in Our Property Markets seminars. Click on the link below and find out when Ed and I will be in your state. You see, it's the last time we'll be getting together in 2008 to conduct our seminars. Our schedules are full up, so please book your place right now by clicking on the link just here.